Welcome to CoreLogic's housing market update for October 2024, brought to you by onthehouse.com.au. The latest housing data shows values are still rising, at least at a macro level, but the pace of growth is losing steam and conditions are becoming more diverse from region to region. Nationally, housing values rose 1% in the September quarter, the lowest growth in the National Home Value Index over a rolling 3-month period since March of 2023, when the market was moving through the early phases of the current upswing. Demonstrating the diversity of housing conditions, 4 capital cities recorded a fall in dwelling values through the September quarter, led by Melbourne, where housing values were down 1.1%, and Canberra, Hobart and Darwin also recorded declines over the quarter. Sydney home values have continued to rise. However, the 0.5% increase through the September quarter was the lowest growth result since the 3 months ending February of 2023, when values were down by 0.3%. The mid-sized capitals, which have led the pace of capital gains through most of the upswing, are also losing momentum, although the growth conditions continue to significantly outpace other capitals. Perth values are up 4.7% through Q3, easing from 6.2% in the June quarter. The quarterly gains in Adelaide look to have also reached a peak at 4% through the quarter, and Brisbane's quarterly rate of growth has eased back to 2.7%, the lowest rise over a rolling 3-month period since April of last year. The slowdown in the pace of growth comes as homeowners increasingly look to sell. The flow of new listings coming onto the market was tracking 3.2% higher than a year ago nationally, to be 8.8% higher than the previous 5-year average for this time of the year. The rise in real estate inventory is a seasonal trend, with spring and early summer one of the busiest periods of the year for selling. However, the flow of freshly advertised housing stock hasn't been this high at this time of the year since 2021. Alongside the rise in real estate listings, we've also seen vendor metrics soften, signaling weaker selling conditions. Auction clearance rates have wound back to the low 60% range across the combined capitals, which is about 4 percentage points below the decade average. Similarly, homes sold by private treaty are staying on the market longer, with a median of 32 days to sell nationally through the September quarter, up from 29 days in the June quarter and 27 days a year ago. Growth conditions across regional housing markets have also eased, with the quarterly trend in the combined regionals index reducing from 2.3% in the 3 months ending April to 1.7% in the June quarter, and more recently to 1% over the September quarter. Similar to the capital city trends, regional parts of Western Australia, South Australia and Queensland are leading the regional housing trends, while values are trending lower across regional Victoria and regional Tasmania. Rental growth is also settling down, with our national rental index rising by just 0.1% over the September quarter, the smallest change over a rolling 3-month period in 4 years. Sydney, Brisbane and Canberra all recorded a reduction in rents over the quarter, and rental growth is clearly losing steam in most of the other capital cities. The slowdown in rental growth is likely to be a factor of both easing net overseas migration alongside rental affordability pressures, forcing a restructuring of demand. Net overseas migration is reduced by 19% from the record highs in the first quarter of 2023, helping to take some pressure off rental demand. With a portion of household income dedicated to rental payments at a record high, it's likely the average household size has continued to increase as group households and multi-generational households become more common, further reducing demand. Melbourne continues to move through what has so far been a reasonably shallow downturn, with values falling 1.1% through the September quarter. Since moving through a cyclical high in November last year, the market's now down 1.9% to be 5.1% below the record highs set back in March of 2022. Listing numbers have tracked higher through spring, 8% higher than a year ago and 21% above the previous 5-year average. With market conditions now favouring buyers, auction clearance rates have fallen to below average levels, and homes are taking longer to sell by private treaty, with a median of 41 days on market compared with 27 days a year ago. The immediate outlook for housing markets is for further growth in housing values, at least at the macro level, but a continuation in the gradual loss of momentum and increasing diversity across the cities and regions. Upside factors for housing conditions include improving sentiment amid a slowdown in inflation, tight labour markets, and a consensus that the next move in interest rates will be a cut. Household balance sheets are also benefiting from tax cuts and energy rebates that could help to lift sentiment and borrowing capacity, while real income growth would be supported by a further slowdown in inflation. Additionally, constraints on new housing supply look to be entrenched due to squeezed profit margins for builders, scarcity of trades, and significant competition with the public infrastructure sector. An ongoing undersupply of newly built homes will naturally keep a floor under housing prices and rents. A cut to interest rates is looking likely either early next year or even late this year, which will provide a boost to borrowing capacity and should help to support a further lift in confidence for households to make high commitment decisions, like buying a home. However, other downside factors may at least partially offset these upsides. Housing remains unaffordable across every metric. The portion of household income required to service a new mortgage for the median income household was at record highs in the June quarter at 50.3%. The dwelling value to income ratio at 7.9 is only marginally lower than record highs, and it would take 10.6 years for a household on the median income to save for a 20% deposit to buy the median priced dwelling, assuming they can save 15% of their income each year. While lower interest rates will help to improve serviceability, mortgage rates or housing values would need to come down significantly or incomes rise substantially before affordability metrics return close to average levels. A further rise in real estate listings is likely as the seasonal upswing in vendor activity continues. Higher advertised stock levels should provide buyers with some additional leverage at the negotiation table, a factor which is already dampening selling conditions and helping to take some heat out of the market. If the first month of spring is anything to go by, purchasing activity isn't quite keeping pace with the flow of new listings. Markets where stock levels have lifted the most are unsurprisingly the weakest from a values perspective. A further rise in advertised supply is great news for buyers, but for vendors it means more competition and the potential for a further softening in selling conditions. There's plenty of trends to keep across as the spring selling season progresses. If you'd like to keep up to date with all the property sector updates, make sure you tune into the news and research pages at the CoreLogic website.